Hello viewers, welcome to my channel. I'm Hasham here. Now I'm going to start, in this video I'm starting a new subject, Managerial Accounting. I got number of requests from the students, from my regular viewers. They want this subject on Managerial Accounting. So I have decided to give a series of videos on this subject of Managerial Accounting. See here, Accounting is the art and science of recording the transaction, analyzing, interpreting, and preparing the financial statement, supplying the information to the concerned parties so that the parties can take prudent decisions. So accounting have different branches: financial accounting, cost accounting, management accounting, human resource accounting, responsibility accounting. So many different branches of accounting are there. With every branch will have their own objective. Just like financial accounting is concerned with recording the transactions in order to prepare the financial statements. Cost accounting is concerned with recording the cost, ascertaining the cost, and to control the cost. Similarly, managerial accounting, it's a branch of accounting which is concerned with supplying the necessary information to the management. The driver of the business is the management. If the management takes a right decision, then definitely business can be able to achieve its objective. The steering, the control, everything is in the hands of the management. So how the management can be able to run the business? By taking decisions. And for taking decisions, management requires information. So there should be a specific department, a branch, which should supply the necessary information as and when it is required by the management. The management can be able to take prudent, timely, viable decisions. So ultimately, success of the business depends on the decision making of the management, and decision making of the management depends on the information provided. So this managerial accounting is a branch of accounting which is concerned with supplying the necessary information to the management. So the person in charge of this managerial accounting, management accountant. So management accountant has to apply a number of techniques in order to supply the necessary information as and when it is required by the management. So what are the techniques which are useful, which are necessary for performing the functions of management accountant? Number of techniques are there. Example, financial statement analysis, comparative statement, common size statement, trend analysis, funds flow analysis, cash flow analysis, ratio analysis. Apart from that, costing techniques. The costing techniques are marginal costing, break-even analysis, cost volume profit analysis, and budgetary control, standard costing, variance analysis. All these are the techniques which are used by management accountant in order to process the data, convert it into information, and provide this information to the management for taking prudent decisions. So the techniques which are applied by managerial accounting are very wide. Just now I told you. But in our subject of managerial accounting, I'm going to cover up only 3 topics. Those 3 topics are marginal costing, decision making in marginal costing, budgetary control, standard costing, and variance analysis. Only this much I'm going to discuss right now in this subject of managerial accounting. So in this video, I'm going to explain you what is marginal costing, how it will be helpful to the management. What is this technique called marginal costing technique? I'm going to explain. So if you watch this video till the end, definitely you will get a lot of confidence on the topic, on the subject. Conceptual clarity you can be able to get. You don't find any difficulty while solving the problem. So don't skip in between, watch till the end. Now, first topic, first item, techniques used by management accountant. So management accountant will use a number of techniques in order to perform his functions. Just now I told you the techniques are cash flow analysis, funds flow analysis, ratio analysis, comparative statement, common size statement, and apart from that, marginal costing, break-even analysis, and cost volume profit analysis, budgetary control, standard costing, variance analysis. All these are the techniques which are used by management accountant to perform his functions. Now the concept of cost. See here, the concept of cost must be very much clear to the management. Cost means the expenditure incurred to produce the goods or to provide the service. Business is concerned with producing the goods and providing the service. So whatever the cost incurred, the expenditure incurred in producing the goods and to provide the service are called cost. Now until and unless the classification, the behavior of cost, the controllability of the cost, relevance of the cost, all these things must be clear in mind of the management. Then only management can be able to control the cost. Why it is necessary to control the cost? Nowadays market is very competitive. Only the fittest can survive. So if a business wants to increase the profitability, two options are there. The first option, increase the selling price. Increase the selling price, our profitability will increase. But that is not so easy, because if we increase the selling price, the demand of our product will come down because there is a lot of competition in the market. We cannot indiscriminately increase the selling price. So what is the alternative then? Control the cost. Control the cost. Money saved is money earned. So that is in our hand. So how to control the cost? Until and unless we classify the cost, we study the cost behavior, we have to study the controllability of the cost, relevance of the cost, number of things. जब तक कि वो cost के बारे में study नहीं करेंगे, you cannot be able to control the cost. Control the cost, right? So classifying the cost. One broad method of classifying the cost. Earlier we know the cost can be broadly classified as direct cost and indirect cost. The direct cost are the costs which are specifically incurred to produce a particular product, to produce a particular commodity. The specifically cost incurred are called direct cost. Indirect cost is a common cost which is incurred on producing all the products. All the products. So indirect costs are also called the overheads. That classification already we know it. Now another method of classifying the cost is fixed cost, variable cost and semi-variable cost. Fixed cost, name itself is clear. The cost which remains fixed irrespective of the level of production, level of output. That means whatever be the level of output, whatever is the production, the fixed cost will remain same. It will not change. That is called fixed cost. Example, rent of the premises. Suppose we have taken a building or suppose a premises on rent. So there is an agreement, monthly we will pay so and so amount as rent. So the landlord will not see how much production we have made. Whether we are producing more number of goods or less number of goods, the landlord is not at all bothered. He wants only rent monthly. So the rent is the best example of fixed cost. The total fixed cost will remain same. That's why it is called period cost. The fixed cost is called period cost because it is related to the period. The period means week or month or year. So that's why it is called related to period cost. Next, one more thing. The fixed cost total will remain same, but per unit fixed cost will decline as the output increases. As the production increases, the per unit fixed cost will decrease. If the production decreases, the per unit fixed cost will increase. Inverse relationship. Inverse relationship between the output and per unit fixed cost. But the total fixed cost will remain same. Next is variable cost. The variable cost is the cost which varies proportionately with the output. With the output. For example, if the production increased by 10%, variable cost will also increase by 10%. If production is decreased by 10%, variable cost will also decrease by 10%. Proportionately, it will go along with the production. So total variable cost will change proportionately with the production. No production, no variable cost. More production, more variable cost. Less production, less variable cost. The total variable cost will change proportionately, but per unit variable cost will remain constant. The per unit variable cost will remain constant. Best example of this variable cost is material cost. Material cost is the best example I can give for variable cost. Next is semi-variable cost. Partly fixed, partly variable. To some extent it will be fixed, later on it will be variable. That means this semi-variable cost will also change, but it will not change proportionately. It will not change proportionately with the production. To some extent it will remain fixed, later on it will become variable. Example is telephone rate. When we pay telephone bill, there is a fixed component as well as variable. For example, the telephone department will say monthly you have to pay for 200 rupees as fixed rent. Apart in that 200 rupees, 50 calls are given. Suppose, so up to 50 calls you make 200 rupees fixed. Over 50 calls, every call will be accounted. For every call 1 rupee suppose. So up to 50 calls, 200 rupees fixed. Even if you do not make the call at all, you will get 200 rupees bill. If you make 10 calls, 200 rupees. If you make 40 calls, 200 rupees. If you make 50 calls, 200 rupees. If you exceed 50 calls, every call will be charged. That is the example of semi-variable cost. Now, marginal costing versus absorption costing. One point you remember, when the management understand the nature of behavior of cost, then definitely we can be able to control the cost. Some costs are controllable, some costs are not controllable, uncontrollable. So which are the controllable costs? The management will focus on that cost so that the cost should be reduced, the profitability increased. Now, marginal costing versus absorption costing. Costing is a technique or process of ascertaining the cost. Every businessman wants to find out the cost of production. Without ascertaining the cost of production, we cannot fix the selling price. The selling price depends on cost of production. So how to ascertain the cost of production? That is costing. So two types of costing are there: absorption costing and marginal costing. Absorption costing is the traditional costing or full costing. In this absorption costing, all the costs are charged to production. No distinction is made between fixed cost and variable cost. Every cost will be treated alike, same. So we will find out the total cost. Simply absorption costing is concerned with ascertaining the profit. How to calculate profit? Total sales minus total cost. And total cost consists of fixed cost as well as variable cost. Combined together, every cost is included. So this absorption costing will not differentiate between fixed cost and variable cost. It's a traditional old method of finding out the cost. But this method of absorption costing has many defects. The limited advantage of this absorption costing is we can be able to ascertain the profit. Only for finding out the profit or to make the quotation, then absorption costing is better. But for decision making purpose, absorption costing is not at all helpful. The management has to take the decisions on the basis of cost. So that's why this absorption costing, traditional costing, full costing is not helpful. What is the alternative? Marginal costing. What is marginal costing? Marginal costing technique will consider only variable cost. The fixed cost will be segregated. So before applying marginal costing, we have to segregate. We have to find out how much total fixed cost, how much variable cost. Separate them. Don't mix up, because the nature, behavior of fixed cost and variable cost are different. So what is this marginal cost? Marginal cost is the extra cost incurred when production is increased or decreased by 1 unit. When the output is increased or decreased by 1 unit, how much is the change in cost? That change in cost by increasing or decreasing 1 unit, the change in cost is called marginal cost. Marginal cost. And change in cost means variable cost, because when 1 unit is changed, will the fixed cost change? No. The fixed cost will remain same. Then which cost will change? Variable cost will change. That's why marginal cost means variable cost. Marginal cost means variable cost. So it's a marginal costing means it's a technique of costing in which we segregate fixed cost and variable cost. So first of all, we consider only variable cost. So from sales, we deduct the variable cost, we'll get the contribution. And this contribution is available for meeting the fixed cost. After meeting the fixed cost, the remaining amount is profit. Remaining amount is profit. That is marginal costing. Marginal costing is very, very helpful for decision making purpose. Management has to take a number of decisions like fixing the selling price, ascertaining the profit, make or buy decision, continue or shut down the plant, different type of product mix. So many different types of managerial decisions are there. Taking those managerial decisions, we apply marginal costing. This topic itself, this chapter itself is called marginal costing. Now, break-even analysis. The break-even analysis is a vital tool for management accountant for taking number of decisions. So what is this break-even analysis? Two views are there regarding. The narrower view. The narrower view of break-even analysis says break-even analysis is concerned with ascertaining the break-even point. Ascertaining the break-even point, finding out the BEP. What is BEP? The point at which there is neither profit nor loss. The sales is equal to cost. Total sales is equal to total cost. That is called break-even point. So to ascertain the break-even point is called break-even analysis. This is the narrower interpretation. The broader interpretation says break-even analysis not only is concerned with finding out the break-even point, but also ascertaining the profit at different levels of output. Ascertaining the profit at different levels of output production. That is the wider definition of break-even analysis. Now, break-even point. The break-even point is that point at which there is neither profit nor loss. That means the sales will be equal to total cost. Total sales is equal to total cost. That is called break-even point. No profit, no loss. Example, if I say my business will break even, suppose I am the producer of air coolers. So I will say that monthly if I produce and sell 150 air coolers, I will be at BEP. I will be at break-even point if I sell 150 air coolers every month. That means if I sell less than 150 air coolers in a month, I will incur loss. If I sell more than 150 air coolers in a month, I will get profit. If I produce and sell exactly 150 air coolers, no profit, no loss. That point of 150 air coolers at which no profit, no loss is called break-even point. Is called break-even point. The break-even point can also be ascertained in rupees, in value. Suppose if I calculate and say that monthly at 3 lakh rupees sales, I'll be at break-even point. That means when my sale proceeds, when my sales revenue is 3 lakh rupees, I will be at BEP. That means when sales bills are exactly 3 lakh, no profit, no loss. When sale bill is more than 3 lakh, I will get the profit. If the sales are less than 3 lakh, I will incur loss. So that 3 lakh rupees is the break-even point. Next comes margin of safety. The margin of safety is the excess of actual sales over break-even sales. Excess of actual sales over break-even sales. That is called margin of safety. So margin of safety is the excess of actual sales over break-even sales. For example, in my business, the break-even sales are 5 lakh rupees. When I sell the goods, 5 lakh rupees total sales, I will be at BEP. Suppose my actual sales are 8 lakh rupees. My actual sales are 8 lakh rupees. Then how much is the excess? 3 lakh. At 5 lakh rupees, I am attaining BEP. Actual sales 8 lakh. So 8 lakh minus 5 lakh, 3 lakh. This 3 lakh rupees is the excess of actual sales over break-even sales. That is called margin of safety, MOS. So margin of safety shows the financial strength of the business. जितना मार्जिन ऑफ सेफ्टी ज्यादा रहेगा उतना बिजनेस का फाइनेंशियल स्ट्रेंथ ज्यादा होगा. देन वी हैव ब्रेक इवन चार्ट. ब्रेक इवन चार्ट इज अ ग्राफिक प्रेजेंटेशन ऑफ ब्रेक इवन पॉइंट. तो ब्रेक इवन पॉइंट मालूम करने के दो मेथड है. फर्स्ट, बाय अप्लाइंग द फॉर्मूला वी कैन फाइंड आउट द बीईपी. Secondly, we can draw a graph paper. On a graph paper, we will draw a diagram, and through the diagram, we can be able to, through a chart, we can be able to find out the break-even point. So, break-even chart is a graphical method of ascertaining, of finding out the BEP. While doing the problem, I'll do one or two problems on preparing break-even chart. On a graph paper, on x-axis, we will take the output, capacity or production. On y-axis, we will take the cost and revenue. Revenue means sales. The cost and sales, we will take it on y-axis. X-axis will take the number of units. By taking the data, by plotting the data on the graph paper, we can be able to find out the BEP, break-even chart. But while doing the problem, I'll explain. CVP analysis. Cost, volume, profit analysis. It's a technique of making the relationship between the cost of production, the volume, cost, volume and profit. These three will have some relationship. That means if there is a change in cost, it will affect the profit. If there is a change in volume, it will affect the profit. So all the three, cost, volume, profit, will have some relationship. By making that relationship, we can be able to take a number of decisions. Next is advantages of marginal costing. See here, this marginal costing is a very, very important, vital tool in the hands of the management for taking a number of decisions. The management has to take the decision regarding fixing the selling price. The management has to take the decision regarding product mix. Different products are produced. A, B, C, D, E, different products are produced. The management wants to find out how many units of each of the product has to be produced. Product mix problem. Again, marginal costing will be helpful. Make or buy decision. A number of decision cases are there where management has to take the decision whether to make the product or buy it from outside. Make or buy decision. Similarly, a number of other managerial decisions are there which can be solved by using this marginal costing technique. This technique will give you the correct cost of production so that we can be able to take correct decisions. Similarly, limitations of marginal costing. Marginal costing will also have a number of limitations. Limitations means obstacles. Now, marginal costing depends on number of assumptions. The marginal costing will be as good as the assumptions are based. If assumptions are correct, then marginal costing will be good, can be reliable. Example, the marginal costing says all the cost can be clearly classified into fixed and variable. Without dividing the cost into fixed and variable, we cannot apply marginal costing. That is the first point. But in real practice, it will be difficult to segregate. Many a times, a cost will be somewhat in between fixed and variable. It cannot be demarcated separately, fixed and variable. Similarly, a fixed cost may not always be fixed. Afterwards, it may become variable. Variable cost may become fixed cost. This is the assumption. Another assumption is the selling price remains same. It may change. The selling price may change. The cost we expect that it will remain same. It may change. So this marginal costing depends on number of assumptions. If the assumptions are satisfied, then definitely we'll get a lot of benefit, advantages from marginal costing. Suppose if the assumptions are not satisfied, then we will not get the true result by applying this marginal costing. So anyway, we should not say that advantages or the limitations are more, so marginal costing will not be helpful to the management. No, the advantages are exceeds the limitations. Advantages are more than limitations. That's why it has applicability. Right? So this is the brief explanation of this chapter called marginal costing. Now, what are the formulas? The complete problems are dependent on the formulae which are used in marginal costing. So 7 formulas I have given here. Just you have to remember, you copied down these 7 formulas. Without formulas, you cannot be able to solve any problems. First one, formula in marginal costing equation. Marginal costing equation is S minus V is equal to F plus P. S means sales, V means variable cost, F fixed cost, P profit. So sales minus variable cost will be exactly equal to fixed cost plus profit. So marginal costing equation says sales minus variable cost will be equal to fixed cost plus profit. First equation, first formula. Second, contribution. Contribution is the excess of sales over variable cost. Excess of sales over variable cost. For example, in my business, 10 lakh rupees are the sales and 6 lakh rupees is the variable cost. 10 lakh rupees sales, 6 lakh rupees variable cost. So 10 lakh minus 6 lakh, 4 lakh rupees is the contribution. So sales minus variable cost is equal to contribution. C is equal to S minus V, or C is equal to F plus P, because S minus V is equal to F plus P. Here it is there. S minus V is equal to F plus P. So in place of S minus V, I can write F plus P. So these are the two formulas for applying contribution. You will get the same answer. Depends on information. Profit volume ratio. It is called PV ratio. It is the ratio of contribution to sales. Contribution to sales. The formula for PV ratio is C by S into 100. In place of C, I can write S minus V. So in place of C, I can write S minus V by S into 100. Or in place of C, I can write F plus P by S into 100. Whatever formula you apply, you will get the same answer. It depends on the information given in the problem. One more formula is that PV ratio is equal to change in profit by change in sales into 100. This formula we will apply when 2 period information is given. When 2 year data is given, we apply this formula. Change in profit by change in sales into 100. Next is break-even point. The break-even point is that point at which there is neither profit nor loss. The total sales and total cost will be equal. That is called break-even point. The BEP can be calculated in units and also in rupees. If you want BEP in units, fixed cost divided by SP per unit minus VC per unit. SP means selling price. Selling price per unit minus variable cost per unit. And BEP in rupees is equal to BEP in units into SP per unit. Whatever BEP in units you get, multiply with selling price. Then one more formula, BEP in rupees is equal to fixed cost by PV ratio. One more formula, F into S by S minus V. Any formula you apply, you will get the same answer. It depends on the information given in the problem. The formula to be applied depends on the information. So BEP in units, this is BEP in rupees. Now margin of safety. The excess of actual sales over BEP sales, that is called margin of safety. So margin of safety formula, actual sales minus break-even sales. Similarly, MOS is equal to profit by PV ratio. Both formula will give you same answer. If it is asking you MOS ratio, then formula MOS by sales into 100. Margin of safety by sales into 100. You will get MOS ratio. Sixth formula, sales required to earn a desired profit. Suppose it is asking you in the problem, how much sales required to earn a desired profit? Fixed cost plus desired profit divided by PV ratio, profit volume ratio. Fixed cost plus desired profit divided by PV ratio. This will give you sales required to earn a desired profit. Similarly, last formula, number of units required to earn a desired profit. Number of units required. So it is equal to fixed cost plus desired profit divided by SP per unit minus VC per unit. So what is the difference between this 6th and 7th formula? In 6th formula, denominator PV ratio. In 7th formula, denominator SP per unit minus VC per unit. Here you will get the number of units. Here you will get the total sales required in rupees. That's all. So we have completed the theoretical part of this chapter called Marginal Costing of the subject Managerial Accounting. So if you are satisfied with my lecture, give a like to the video. Share it in your group, in your friend circle, so that more students can get the benefit from this channel. And give your special comments regarding these lectures. And don't forget to subscribe my channel if you have not yet subscribed. We'll continue the problems in the next video.